Hello, good afternoon. It's Wednesday, 1 o'clock, and we are starting our Modern Investing with Sasha. It's an investment show. We are all going to learn something, hopefully from each other. Hopefully I will be able to help some of you. Some of you will help me. I really hope so. And let me introduce our guests for today's show. Let's start with Jim Ida, who is a regular actually on our financial shows. How are you doing today?
I'm doing wonderful, and I have my notepad.
Excellent, excellent. We also have, for the first time, Matthew Vernovitsky. He is from Collingwood, Ontario, Canada. He is a novice investor, and he would like to listen to what we have to say and maybe learn something from it. I hope so. Do we have any other guests today so far? Maybe some of them are late. And so they will join us as soon as they're here.
Okay.
So let's start now, since just three of us here. Let's talk about something from very, very basic things, what we are trying to do and why we are here. The reason why we are here is that interest rates are so low that on fixed income, you'll be lucky to get 1% annual return, which makes it impossible to for young people to make any meaningful return on their investment. And even for older people like we are, we can't support ourselves, our pensions and whatever we might have on 1% annual return a year. So we need something a little bit more than 1%. Now, if you need more than 1%, then forget about fixed income and you have to go right into stocks, options, and other things. However, as I said before, and I will always keep repeating myself, the rule number one of any investment is preservation of capital. Jim, rule number two?
Rule number one, preservation of
rule
capital.
Number three, rule number one and number two. Okay, so we now, as a preservation of capital, whatever we are trying to do, is far the most important object. Okay.
Right.
So since we understand about fixed income, that it's just not the time now to invest in it. I mean, for personal investors, maybe institutions are investing in fixed income and trading bonds and so on. I'm aware of that, but on a practical side, for individual investors like we are, it's not going to work. So if we're moving into stocks and options, let's start with stock as it's much simpler. Jim, could you tell us exactly what do you mean by stock? What, in your opinion, is it?
Well, I buy a share of a company when I buy stocks, or I buy shares. In other words, I'm investing in them to do well, and I'm predicting that my shares of that company will have more value in the future than they have today.
So essentially, when you're buying a share of Microsoft, for example, right? So you're buying a little tiny piece of the company, but not piece of their building. No, you're buying piece of whatever business they're doing around the world. You're buying a tiny portion. If you're buying one share, it's a one probably fourth billions, and if you're buying 1,000 shares, a little bit more, it's one of the percent of a million of Microsoft, and so on. Depends how many shares have been issued and outstanding. Okay, Matthew, how do you understand the shares, and do you understand really what's happened with you when you are buying? See, Microsoft today is worth, I think it was $210 one share. So if you buy 100 shares, it will cost you, say, $21,000, right? So what do you think happened? What exactly are you buying for this money, in your opinion?
I think when you buy shares, you buy, potential growth. I think a lot of it comes down to how you predict, a certain company or specific business to do in the future. And I think a lot of the time when you're buying shares, you're buying usually for the average person a small percentage of that company, and you kind of I think as you see the company doing well, you yourself get back some increased income as well.
Okay, I think basically you are trying to participate in a company's growth. However, if the shares will go down in price, you are participating in that as well. So you're taking a risk of higher return, but also possible downside if the stock will go down in price. Okay, so that's why investment in stocks is riskier than fixed income, because in fixed income, if you're buying quality bond, for example, you're most likely guaranteed return of say 1% a year. So you invest, let's see, $1,000, and a year later you will get back $1,010. And $10 is 1% of 1,000. When you're buying Microsoft shares worth $1,000, if you buy 5 shares of Microsoft, it's approximately worth say $1,000. Now you really depend on how well Microsoft will do its business, how well the shares will appreciate up in price. However, they can depreciate as well. And not because Microsoft is not executing so well. It could be several other factors. World economy can go down, including US, all these coronavirus factors and many others. So you are obviously taking a risk. You want to get higher return, but you're also taking a possible downside if things will not work out. In case of Microsoft, maybe it could be argued that the upside. Thank you, Jim. So Microsoft is up today.
Yes, and if you bought it 3 months ago, you would have made money. But
yeah, and by the way, guess what? Microsoft is reporting after the market closed today. Yeah, so.
So people are betting that it's going to be good news.
Hello?
I think people are betting that it's good news because the stock is up today. So they think that when the quarterly report comes out, that they'll be getting good news.
Okay, I got a message from Zach, who also is going to join our show very soon, hopefully. Okay, so we've discussed the situation, and Microsoft will report. It's normally they exceed the expectations, and I would be really surprised if they're not going to do it tonight. But.
Yes, you never know.
You know what I mean.
Yes.
Actually, very often what's happened with the earnings is that they do have fantastic earnings, yet the stock falls down. Oh, it's happened recently with Netflix. If you remember last week, they had fantastic, the new customers that was going through the roof, and they had fantastic report. But one number didn't, the analysts didn't like one number, and the stock tanked $50 a share in kind of in 10 seconds. That was really funny. I didn't have any shares or options on Netflix at the time.
No, I don't.
But that's a danger of earnings reports or so on. But if you want to get more than 1%, that's what you have to go through. And so,
well, Sasha,
I
was going to ask you because my father had a savings account and it paid a pretty good rate of return, and for his day and age, it really worked to be saving. But right now, it doesn't make any sense for someone to be putting their money in their savings account, earning these paltry returns. Do you think that in the future that might be another reasonable thing to do? Or is it just now that we're talking about? Just now, the rate of return is paltry. So we have to think about stocks or other options that may give us more potential earnings. And do you think it'll come back, though? Do you think it'll turn around?
Well, as you know, the interest rates are at the lowest all over the world. And I really don't see how U.S. could possibly raise significantly interest rates in the near future. I mean, probably it will, but I don't see. You see, okay, let's think a little bit further. If you raise interest rates, so obviously your goods will become less competitive, right, than in other environment. So because your dollar will go even higher, dollar high is high enough against other currencies. Now let's see, let's imagine it goes up against euro, for example, right? So all your goods which are priced in dollar and which is going higher, they will remain much less competitive. Actually,
They will be more expensive.
yeah, it will be more expensive, and many competitive U.S. industries which export around the world, they will face great difficulties to make their prices competitive. That's what I think.
Yes, I agree. That's what I think too. So,
So
this
if that's
is
the
going to
case,
last for a while, I think, this low interest
it
rate.
will last for a while. Yeah, I don't know. We are looking at 2, 3 years, maybe 5. I really am not sure. I have to see at least some uptick in Europe or Japan or just some other country somewhere. There has to be uptick. Right
Yeah.
now, you know that in Germany there is negative interest rates. How you can compete with negative interest rates? So they're pushing their people to invest in stocks. Because
Yes.
if you have negative interest, let's say you have somewhere lying to say $100,000, right? So you put them in a bank on a preposition that in a year time you will get back 95,000.
Right.
You will run away from that bank, right? He wants to take your $5,000. Okay, so you run away. So you keep your $100,000, but then what to do? You want to get some return on your money. So you have to open a brokerage account and you have to start investing with all the risk inherent. But you know what? The risk, I read somewhere, I forgot the book, that when you take in a risk, you have a little bit of worries. But you know that worry is a good thing. If
Yes.
you are a grown up, normal man and you have no worries whatsoever, is your life really worth much? What are you doing with your life? You are worried. You are living, okay?
Yes.
Come on, hold on, please.
So, Sasha, if I could chime in.
Matthew, I just wanted to ask you, do you have a brokerage account? Because Sasha's on another line now.
Yeah, I do not. I'm very, very novice, as Sasha said. Again, I'm just looking to learn. I will definitely look more intensely into stock market and all these things, and possibly we'll go back a few weeks just to look at trends. But going back to Jim said that Microsoft was up, and then Sasha talked about interest rates being low. You know, and you look obviously with everything that's happened, a lot of people are losing jobs. So maybe can anyone chime in and display their thoughts on why there's such a disconnect because between the economy and how the stock market's performing?
Yeah.
Oh, Matthew! Wow, what a question! Really good question. Jim, could you try to get the right answer to that question?
Well,
I don't think there is a right answer. I think it's hard.
I will take a stab at it, but you know, kids at home, don't listen to me. I do think that it's an excellent question because right now my comment is that the Dow is not the economy, and what's propping up the Dow is that corporations are doing fine. The 1% are doing fine, and so they're and anytime we give them money, they buy back their own stocks. They're happy right now, but the average worker is not happy. So the person has to have money to buy groceries, has to have money to buy rents. They're hurting. So our economy is hurting. But the Dow, the stock market, is still doing well. That's my take, Sasha.
Yeah, okay. I agree with this. And you see, there is stock market and there are indexes specifically for high-tech stocks, and not just high tech, but well capitalized, like Microsoft, like Netflix, like Amazon, and so on. You know all the stocks just well the way I do. But there is no index of a small mom and pop restaurants and little businesses or so on, because if that would be index for these businesses, that index would be down 99.5%, I'm pretty sure, because they're all struggling, and it's a lot of them will simply close the doors and will go out of business. So obviously the stock market, especially if you take a Nasdaq 100, it is really not representative of US economy at all. So we must say, yes, there is a disconnect between Main Street and Wall Street. Yes, there is a disconnect, and you have to understand why. Because it's nothing to do with the real business. We are talking about well-capitalized companies whose business model, in fact, is not really suffering at all. Actually, it's benefiting from all this coronavirus calamity and so on. And you have small businesses which are struggling, and which a lot of them will unfortunately close the door. However, there could be a long-term impact of so many businesses going down, closing the doors, and so on, and that remains to be seen. We can't figure out really what will be impact, but there are going to be a long-term impact. Because it's like a domino effect. Let's see, a small business is closing the doors, so people are collecting unemployment insurance or some subsidies. So they are not going to buy as many goods as they would do otherwise. So the people who are selling those goods, they will suffer in turn as well. So it's a domino effect, and the all how it will reflect on our future well-beings, evaluations of companies and stock market in general, so on, it remains to be seen. And I don't think that even these large companies like Microsoft will be insulated from them. The only thing is, it may take 2-3 years to reach that level, but there will be consequences, of course.
I think so too.
Matthew, are you satisfied with what we were trying to tell you?
Yeah, sorry, I tried to follow as best as I could. I'm just trying to converse with Zach just to get him on here. But
oh, okay, sure. Let him in. Get him in.
Yeah, I'm trying. But I liked how you talked about these are already well established and grand companies, compared to a lot of people that are going out of business. So that definitely made a lot of sense, because a lot of these companies can benefit from this virus, like you said, because a lot of it's online and through a digital platform. So that made a lot of sense for sure.
By the way, let's take, for example, Amazon. Amazon is benefiting big time from what's happening with coronavirus, because you see, a lot of people can't leave their house. So they're ordering on Amazon. So there are a lot of people who never used Amazon before. But once you will use Amazon, you're becoming a customer.
Yeah.
It's a good service. It's quite addictive, but it's working against local small business, mom and pop businesses, and a lot of these businesses, as a result, will suffer even more, and Amazon will benefit even more from that. Look at their shares; they're now over $3,000 a share.
Yeah, it's insane.
Their valuation is $1.5 trillion. Well. Who else is benefiting? By the way, Tesla is doing quite well. Tesla as a company is now representing more value based on stock prices than Toyota, Volkswagen, General Motors, and Ford and Chrysler all put together.
It's unbelievable. It's a sore subject, because I bought Tesla and then I sold when I didn't think it was going to go this high. So I got out too early. But as an investor, I like to have a target price where if I make this much money, then I'd like to get out, because I feel like I've attained my objective. But sometimes you end up kicking yourself because you got out and it still keeps going. Like Tesla is a perfect example of that.
Yeah. Okay, that makes sense. Listen, we all have our failures. I remember that the first stocks that I ever bought, I started to buy it at 50 cents, and it went up to $4.75. My average price was $1.28. I was lucky enough to sell half of my position,
Yes.
around 450, 470. I sold half of my position. The other half I was left with, it went down to 350 and stayed there for almost a year. So I sold another half of whatever I remained, and then it fell all the way down back to 50 cents or so on. But then it was reorganized. So I still had some benefits from the share. But it was a long story. It took them 8 years to reorganize and do well. But sometimes you have to wait. What can you
But
do?
what you're describing is a lot like my theory of playing blackjack. Is like if you get up at a certain point, take half the money off the table, put it in your pocket, because then you're playing with the house money. And it's like that with stocks too. When they go up to a certain percentage, take off half of it, so you can't ever lose if you have that money in the bank already. So if it goes up, great. If it goes down, oh well, I already got my money back. So that's another way to play it.
Well, on stocks, I have 7% rule. When you sell the stock, if it went down 7% from the point you bought it, doesn't matter how low or how high you bought it. If it lost 7%, just get out of it. That's it.
Right.
In a blackjack, I use a 10% rule, which means I'm always watching my maximum amount in a play. And if I lose 10% of that amount, I terminate the game. I just walk away from the table. I change the table. I go to another game. I go to another casino, if it's the case. So I let my winnings run. I don't stop when I'm winning. But I always know approximately how much money I have in my bank account. So
Yes.
right? So let's see, if I start the game with $2,500 and I lost 250, run away from the stable, go to another game, another casino. However, if I win and I got now 3,000, 3,500, okay, let's say I got 3,500 now. Now I can lose 350. If I lose 350, I'm out of the game, out of the casino, and I just terminate. So for the situation in stocks is, okay, every time you play blackjack, okay, you put $100 a hand, that you can lose $100. Okay, if you split, so you lose 200. That's okay, that's all. However, in stocks, it's a different story. You bought Microsoft, for example, God forbid, at 210, and it can go down to, let's see, it can go down to 195, but guess what? It can go down to 175. It can go even to 145. So there is basically unlimited losses. So how to get out of the stock? So if you bought at 210, let's say you lost $15, just get out of it. So if it goes down to 195, get out.
Get out. But this is the other thing, Matthew, that I think Sasha is telling us is that you have to be a disciplined investor. You don't want to ever put all of your marbles in one basket. And if you're starting to take a loss, get out. And if you're starting to make money, put some of it aside so that you don't lose it all. You could always lose it all, and don't let yourself get into that situation. Make sure you have a stop.
Yeah, it's like anything in life, right? You want to show some restraint. It's very tempting when you see something's going well to put all your chips in, and you might even get some recommendation to. But it's best to show some restraint and only put in what you can honestly afford for the future. Now, in addition to that, we've seen some stock market crashes in the past. We've seen a housing market crash not too long ago. So do you think that with the times now in the economy that the stock market is due for some sort of correction or even a crash?
Great question.
It's a great question. Actually, I'm scared of crash every minute and a half. It's just a normal thing. I'm watching the market. Okay, what is the Microsoft now? $210. Great, but I will not be surprised if it's after report. Even if it's going to be very good report, Microsoft can go down to 195. I will not be surprised whatsoever, not at all.
Yeah.
So you have
Sometimes
to
these reports
be
are good, but
mentally,
not
you
good
have to
enough.
be ready. Sorry?
Sometimes these reports are good, but not good enough for the investors. So they punish the stock even though they performed well. So.
Well, there is a lot of investors or speculators, you want to call them, who are playing this reports game. So they're buying stocks before report and then sell it on the report. And when they sell, it doesn't matter if it's a good report. If it's a bad report, it's understandable. Okay, so everybody wants to sell, right? But if it's a good report, you still sell because that was the reason why you bought the stock in the first place. You were waiting for report. Okay, here is your report. Now please sell. Thank you. Bye-bye.
Right. But the other thing, the other lesson that I'm hearing is also play with money that you can afford to lose. It's got to be discretionary money. You don't want to put your rent money into the market. You've got to be able to have your bills covered. And then if you have money left over, invest.
Yeah,
But,
that's a correct way. Of course, you need a sort of. It would be nice to have a steady income from which it will allow you to take care of your expenses. Then you put certain amount of your income into investing. It doesn't matter how small it is, even if it's $100 a month or $500 a month. It doesn't matter. But whatever it is, you just keep building your war chest. So it will take you maybe a year, maybe 2 years, and you will have a significant account. You will start using different strategies. Now, something we would like to talk about diversification. There are two concepts. One is allocation of capital. Allocation of capital is between fixed income and stocks and options and so on. Another one is diversification. It means that instead of putting all your money in one stock, you're trying to get diversified. Now, with a small account, let's see if you have maybe $10,000 account. Like a lot of beginners, that's what they normally start with 10,000, right? So, how you can really diversify with $10,000?
very difficult.
It's a very difficult approach. However, it's possible. The only thing is, instead of 10, 15 stocks, you will have maybe 2, 3 stocks. That's all. And I mean, if you have 2, 3 stocks, it doesn't have to be all in the same industry. For example, oh, hello, we have a new attendant in our show. Okay,
He persisted. He
Hello.
got in.
the
Yeah,
Oracle of
I got in. I had
Nigeria.
to work through it, but that's what the show's about.
Absolutely.
Okay, thank you for making it through, though. Zach, we are talking about diversification for small accounts. Let's see if somebody starts with a very small amount, say $10,000. How can you really diversify with $10,000? It's very difficult. What are your thoughts on that?
My idea with that is I would say I would use ETFs in that situation, because then without having an abundance of capital, you can have access to a lot of different positions. So like, as an example, you could buy an S&P 500 index that could be trading at like $20 per unit. And each of those units then will reflect the entirety of the S&P 500. So that way, then it's like you own all the companies within the S&P 500 without having to have the many, many tens of thousands of dollars that it would require to do that.
Right.
That's quite possible. And I think it's a little bit passive style of investing, because you really now depend on the market overall. How is the market going to do it, going higher or lower, or so on? I would propose a somewhat different approach, not much difference, just more to my taste. For example, I would consider 2, maximum 3 leaders in their industry. So it would be, for example, Microsoft. Obviously, it's a leader in its industry. I would probably choose, of course, Amazon is a leader in its industry. There is nobody comes even close to Amazon in what it's doing. And I would possibly go into food retail industry, and to me, Costco is a leader in that industry as well, for obvious reasons, because Costco in just fees, what it generates from customers, It beats out Walmart
Huge.
and all the other retailers just for the fee. So they don't even have to sell the food at profits because their fees, the annual fees, what they're collecting, it just easily beats anything on this earth. So obviously Costco would be a stock. So if you limit your, say, $10,000 with a choice of 3 stocks, which would be, say, arguably Costco, Amazon, and Microsoft, I think you're somewhat diversified. I mean, you cannot ask any more from $10,000 than that.
Exactly.
Right.
And,
So you're diversified. You're not dependent on one stock. It's very unlikely that one of the stocks will go bankrupt, that will be delisted or anything like this. Very unlikely.
That's true. That's unlikely.
Right.
That, especially like you said, if it's a leader in the industry, then the odds of it.
Absolutely. So
Like,
I would
is it
recommend,
possible? But yeah.
Yeah, of course, anything's possible, but you know,
Yeah,
we're betting on probabilities now.
Yeah. Playing the
Absolutely.
math. Yeah.
Look at Microsoft. It's already below 210. It's only $209.60.
Oh, here's Costco. The last
Oh
3
my
months.
God, it went down. It's
Costco's
going like a
doing
rocket, going down all the way.
Oh, Costco's losing today. But
Costco's losing today. Oh my God. What
Yeah.
about the Amazon?
Amazon, look that up.
Yeah, it makes sense that a lot of these big corporations are going up because, you know, for example, you look at something like Costco. Everyone wants to buy in bulk now and buy in large quantities with the times now. So, you know, a lot of these small businesses.
Amazon with $10,000. I mean, it's trading at over $3,000 now a share.
Yeah.
Okay, so for $10,000, if you're not using margin, you will buy 1 share of Amazon, maybe 10 shares of Microsoft, and the rest of the money you'll spend on Costco.
Well, Costco's reasonable price, close to Microsoft. You could probably get some bang for your buck there, but Amazon is very pricey. It would make me. I would see red flags waving.
Yeah, from a valuation standpoint too, like you look at the current PE ratio that Amazon's working with, like obviously they're an industry leader, but that's one that I think even though they're great, just with how overinflated the market is as a whole right now, I think that's one that kind of scares me in the sort of short to medium term. But obviously if you have a really long horizon, I think Amazon's gonna win the day in the end.
Yeah.
Well, this is, yeah, go ahead, Matthew.
Go ahead, Matthew.
No, I just in addition to that, right? You have to look at both sides of things, right? You can't just be too optimistic to the point of danger. So looking on the other side of things, would any of you kind of consider shorting the market?
What I'd look at right now is I don't like shorting the market as a whole, even if I think it's overvalued, because time and time again, it's proven that it can stay overvalued longer than you can stay in your position. Mm-hmm. But what I would think of doing, and I have been doing with my own account, is I've been having a heavier cash allocation. And I know a lot of people are like, oh, cash is trash, and that's true overall. But as an investor, I always try to remember that it can be an intelligent position, just like investing it somewhere could also be an equally intelligent position. So I think right now I'm partially invested, but I'm also have a higher cash allocation percentage of my portfolio than I usually would if I was comfortable with the market. And then I also have some safe haven allocations just to sort of fend off what could come. So I have a pretty heavy allocation compared to usual in gold and silver and a few other things.
And also, just by safe haven, would you include high dividend stocks?
Yeah, I would.
Yes.
As long as they also had a sort of a valuation that didn't scare me.
Yes.
To go alongside it. Because obviously if they pay a great dividend, but they're crazy overvalued, then they're going to get hit hard too. But you're completely right. If there's a strong dividend at an attractive price, then even though day to day it'll move up and down, you're never going to go wrong with a great valued company that pays a strong, healthy dividend.
Well, I would like to comment that cash allocation, what you have about 50% is about right. It's great. Also, even if market will not go down or much lower at this from this level, it will give you also a new opportunity to buy great companies at lower prices. So the cash exactly would help you to do exactly this.
Yes.
Now, premium on Amazon and other companies, that's what you pay for leaders, unfortunately. Excuse me.
Well, the thing that Sasha and I were both concerned about is
Hold
market
on.
corrections, because we have seen this almost unprecedented bull market for so
Yeah.
long, and we just think it can't continue like this, can it? So at some point we have to be poised to be able to pounce on a correction.
Exactly. Yeah, and that's my thinking too. Is that whether we know that it's going to happen to the day or not, which obviously we can never know to the exact day, we do know that it is going to come sooner rather than later. It's not going to be forever where it's a runaway train. And as you mentioned, we do want to be in a position that when it corrects, we can pounce when others are running away.
Right.
Yeah.
Yeah. So, take a guy like Matthew. Would you tell him to wait and pounce when the market correction happens, or would you tell him to invest now?
What I would tell a guy like Matthew right now, given the crazy, weird historical overvaluation we're in right now, is I would say that now is the single best time for someone to sort of take notes and be a student of investing, because this is I think it's going to turn out to be one of the big lessons of my lifespan. Like, this will be up there with like a 2008 with a 2000
right
type crash. I think we have yet to be seen. So I'd sort of watch how it goes along. Don't participate yet, but then be ready for when it pounces. One, because strategically I think that makes sense, but two, even more important than that, for the rest of Matthew's time interested in investing, he will have this reference point when things get out of hand later and people are just starting to join in and say, no, I've seen how this happens. I watched this before. I'm going to take some off the table and let every new person ever get involved and lose all their money.
Yeah.
I appreciate that. I mean, part of why I'm being on the show is, to be a huge observer. I mean, I definitely wouldn't be one to lead such a discussion. I'd be like a sponge absorbing all the information. So it's actually, I think, in ways you got to be optimistic during these times. And I think for me as a novice, I think it's a great time to learn and observe and be ready for the future when hopefully we get more normalcy.
That's a very wise.
Very wise. So I totally agree with you. You see, one interesting thing about the market is that regardless what you think and what strategy you use, and unfortunately there is no strategies that works always in any market. Unfortunately, it's not so. But one thing is important. Market is always right. You cannot fight the market. You will lose all your money very quickly. So you have to really, really listen what market is trying to tell you. I was many years ago, I read one interesting investment book about stock market and its relationship with the Tao theory. It's old Chinese Confucian teachings. It's very difficult really to describe what it's all about. The main thing, what you have to understand, it's like a kind of a flow of water. For example, like a river, for example, it's a flow. And if you are swimming faster than the flow, you will lose. If you swim across the flow or against the flow, you will lose. The only way to win is becoming part of the flow. So you have to really understand the flow, feel it, and becoming part of the flow. So if the flow is and the kind of a tendency of the market is going higher, it will go higher. And don't fight it. If you can start playing against the market and short the stocks and buying puts and so on, you will lose your money. It's just as simple as that. So you always have to, almost every day, every hour, I would even suggest, listen what is market trying to tell you and try to understand and follow the signals of the market. Otherwise, if you will do, okay, my strategy is the market going higher and so on, you will not get anywhere. Now, we all have, of course, different experiences in investing, different styles, I'm pretty sure. I would like to go very quickly about options, because options can quite seriously enhance your results of investing in stocks. For example, when Jim, when you or Matthew, what did you asked about the dividends paying stocks? Jim, it was you, right?
Really, we're talking about that.
Yeah, I like dividend paying stocks, especially if it's a juicy dividend like 7.5%, for example. If you know that in fixed income today's return is say 1%, and here you have a stock which pays you 7.5%, maybe I'm just too greedy, who knows? But I love the stocks like Altria, for example. Altria pays you 7.5%, and they have a enormous cash flow and free cash. And oh, by the way, you can also sell covered calls against Altria. And I've done it for so long that I think I own very small positions, probably about 700 shares, but they're already paid for through dividends and covered calls that I sold. I already own this stock. Have you ever anybody invested in Altria?
I have
I
not.
know a lot about Altria. I'm not invested in it, but I follow it.
So what do you think about this company? It's about stock.
They definitely have a good moat, as Warren Buffett would say, considering that there's a high barrier to entry. If you want to sell cigarettes, you can't just start a cigarette company out of your garage and have the government think that's okay. So that's definitely an advantage they have. They're also, all major cigarette sales companies have proven that even in the toughest of economic downturns, that's something that people that like that product still buy it. They'd rather stop spending money in other places. That's not really a place where they say, oh, I don't have as much money anymore, so I'm going to stop smoking. They say, oh, I'd rather not have this fancy t-shirt and I'm still going to buy a pack of cigarettes, because that's just how ingrained in them it becomes. So that's a major advantage that it has from a business perspective. And as far as the dividend goes, yeah, it's definitely a big dividend that I think they're, at least in all likelihood, going to be able to maintain paying, which is another big thing. Because when I look at high dividend payers, you look at the payout ratio, sometimes you can work backwards from there and see that, okay, in 1, 2, 3, 4, whatever it may be, quarters from now, there has to be a change made, and that's the first place it's going to happen.
Well, the yield on Altria is 8.22% right now. So
you know, my danger, I still hold to a stock, and I'm collecting dividends. I'm selling covered calls. My only danger is that people like myself will start smoke cigars. Now, if that will happen, that will really, really be a big competition for the cigarettes which Altria is making, and that could affect their stock performance. So that's my danger about Altria.
You in Canada can smoke those Cuban cigars. In the United States, we can't.
Yeah, I know. But there are some good cigars in the United States. I tried some of this. They have really good cigars.
Yes.
Now, yeah, sure, Cuban cigars like Caiba, yeah, they're really, really good. Now, speaking about the covered calls, a very simple thing is Altria. Let me look at my position.
But Zach, your comment about will they be able to keep that yield of 8.22%? That's what you would look at. Do you think they could maintain that?
I think they could, given their business model. But let's say they were a company that was really cyclical, unlike cigarettes. Like, let's say it was something that has been proven to come in and out of favor with people, and you could sort of work backwards and see, okay, during this type of economic conditions, people splurge on this type of product, so then they can afford the high dividend, but then, oh, they can't later on in the cycle. Then in those situations, you can do yourself favors by putting that legwork in, because then you can stay away from a lot of seemingly to the naked eye very attractive dividend payers that aren't so attractive when they lower the dividend.
Very good point.
Okay, I've just refreshed my position at Altria. Now, what it shows, the stock is about 41 and a half, 41 something. Yeah. And what I've done is I've sold a while ago, probably last week or a week before, I sold 42 and a half calls, January 42 and a half calls at $3 each. Okay. So what that gives me, it gives me a protection from 41 something down, all the way down to 38 something. So as long as the stock is 38, higher than $38, I'm not losing any money. Never mind dividends. I'm not even counting dividends at all. Without dividends, I'm already covered, and the downside is 38. Now, if it will go up to 42 and a half by January, not higher, but up to 42 and a half, I still retain the stock and I keep the premium what I've collected from the selling calls. Now, if it goes higher than 42 and a half, then I have an option. I can get rid of the stock. It will be taken away from me, which means I'm exercised. Or prior to that event, I can buy back this 42. In fact, stock has to go higher to 45 and a half for me to buy them back at a loss. It's just a break even. Higher than 45 and a half, then I will incur loss on buying back the calls. However, the good thing about it is that at the same time, I will immediately will sell, say, April 42 and a half calls, or maybe even 45 calls, and I will collect more premium. I will retain the stock, and I will keep collecting dividends. What do you think about this strategy?
I think that covered calls are a great strategy in their time and place, and where they work best is like when you can identify a company that historically in certain conditions is range bound, like okay, there's a high likelihood it's going to stay within a certain range, then that's a good situation to do that in. But if the stock's more erratic, then yeah, you're going to get a higher premium, but then also you're dealing with a quite large risk of a big dip and you being in the wrong exact timing of that sway.
Right.
100% agree with you, because if you today buy Tesla at $1,600 a share, and even if you sell a call and collect a good premium for a call, but stock will dive down to say $12.50, that call will not help you at all. You'll lose a little bit of money here, right, on the trade.
So the
one
more volatile a stock is, the less likely you would be to cover your calls.
Well, what's happened is in a volatile stock, you collect a larger premium, which is a good thing. Now, the bad thing is that it's not going to help you. The stock will go down big time. Or even Netflix. Let's see, last week when it's collapsed $50 in a matter of a minute and a half, even if you sold call to protect yourself, you see, by selling calls, you are accomplishing two things. One, it's a protection against downs. It's not absolute protection. You still will lose money, but at least you will lose less money by selling call. And another one for income purposes, because if you, let's see, most stocks are what they can do. They can stay the same price, they can go down, they can go higher. So if they're the same and they're going higher in price, you're okay with selling call. Okay, you're limiting maybe if stock will run away. Okay, you're limiting your upside, but still you're going to make money. What's happened if the stock is going down? Now you are covered only to a certain extent.
Right.
Although our friend Shaquille was urging otherwise, that you're in fact losing money by selling coal. In certain cases, yes, he's right for sure, but it's again what stock you're talking about. You're talking about Altria, which has very small movements on the way up and on the way down, or you're talking about Tesla, or you're talking about Amazon, or you're talking about other high flyers like Netflix and so on. Then selling coal. It's well, unless you're so greedy that you would sell both calls and puts, close your eyes and then and just hope to collect premiums on both sides. That's all. But I'm not doing that strategy. I know it could be very profitable at times, I wouldn't mind, for example, if tomorrow morning S&P is not going down big time or higher, I may sell Friday expiration both calls and puts and try to collect premium on both sides. It's risky, but it pays you most of the times. Just for one day. For one day, maybe you can do it. But
And
again,
I'm learning too on this, especially on the options side. And so let me tell you what I'm getting out of our conversation, and tell me if I'm right. If I'm going to do covered calls, I'm looking for a stock that has a dividend and has a rather narrow trading range.
Yeah, you want as tight of a range as possible, and also you want pretty strong historical evidence of that range staying consistent. Because even if overall there's a stock that it's good at being range bound, but when it diverts huge, then that might be another one to stay away from with the strategy, right? Because even if you're right 90% of the time, but the 10% you're wrong, you're so wrong that it offsets it, then you're back where you started.
Right.
Well, I think it's important, like in case of Altria, it's important that you, first of all, you understand the company and you're not scared to own the shares, even if you're not right at this particular transaction. So you will end up owning the stock and you will hold it for a longer period of time, say for 2, 3 years, 5 years, whatever it might be the case. And whether it falls into your strategy to own a stock like Altria. Now, if it's not, then you wouldn't buy it in the first place. However, right now, maybe it's not a bad strategy to have at least some of the shares in your portfolio by paying what, 7.5%, maybe even 8%.
Yeah, and I just actually did a brief search on Altria, and I was thinking based off of their old dividend, but since they raised it now, their payout ratio is quite high. They should be able to be okay maintaining it because of how steady their business model is. But I would be careful if they were to raise it anymore, or if anything were to affect their business, because I looked up and now they're at a almost 80% payout ratio, and generally you want to see that being closer to the 60% range or lower if possible, unless there's
well, you know
really
how is it possible? It's possible very easy when the stock will go higher to say $50, $55 a share.
yeah, and
exactly
that works until it doesn't. Yeah.
Yeah. Exactly. That's what I expect will happen. I expect say a year from now, it's going to be between $50 and $55 a share. That's what I'm expecting, actually. And if you look historically, look at last 3 years, they were over $50 a share. So it is.
Sasha, why wouldn't I just buy the stock then? Why wouldn't I just buy the stock if I thought it was going to go up and pay that dividend?
That's exactly what I did. I bought the stock, and I'm collecting dividends, but I'm also selling calls. I'm selling calls as a protection, but also as income. Let's see, I've already described a scenario where stock will go even down to $38. I've described a scenario which will go up to $45 or so. So it's almost like a chess game. Okay, you play opening. So you play e4, so you know what to play against c5 and e5 and c6 and e6 or so on. So you cover your bases. You're not, stock is now $46. What am I going to do? I already know what I'm going to do today. I know what I'm going to do by 3rd Friday of January next year. I know what I'm going to do. Any interesting strategy with options that you're doing?
Yeah, I have a few interesting ones. One of them that is quite intriguing, but there's a few moving parts to it, is because usually I don't like selling cover. I usually don't like covered calls in most market cycles and company cycles. But if I find a company that, as I mentioned before, is very range bound and it doesn't have huge deviations when it breaks its range, then I will. And something I look for to prove that's sort of a more robust way of checking my work rather than just looking at the chart, because that's obviously seeing what it did, but then looking deeper as to why that happened. I like looking at what's called the information ratio equation. So that's, you take the performance of an investment or a group of investments, and then it's that performance of whatever you're measuring minus the performance of whatever an appropriate benchmark is, divided by the tracking error of your investments or the investments that you're tracking. And then that sort of shows you how robust the return stream is that you saw. And it's not perfect, but it's as close to the best sort of anticipator of repeatable returns out there.
Beautiful, beautiful. I wanna your attention now, because first of all, have you heard about person by his name Jesse Livermore?
Yeah,
Okay.
he's excellent.
I'm writing.
I recently bought a book.
Oh yeah. I'm gonna buy it on Amazon.
Yes, it is.
I don't think Matt's read that one yet.
I haven't read it. No, I have not.
However, very important thing is it's annotated edition by John Markman. John Markman is investment genius, I would say. And actually the foreword is by Paul Tudor Jones. You know who he is, right?
Yeah.
He's a king of options and futures trading for last 35 years, probably. So this is really a golden. I mean, you know, there are a lot of investment houses that whoever they hire new people to work, the first thing they say, read this book, and then come back. Okay. Now, what I'd like to do with this book, when you will read it, you will find that what Jesse Livermore did, he was staying by the tape. It shows stock trading, and he was reading the tape. Tape is the king. Tape what tells you what each individual stock is doing. And you know why? Let's talk a little bit about the secrets of Wall Street. How the stocks are actually being traded. Let's say you want to buy now 10 shares of Amazon. But what's happened if nobody wants to sell Amazon? Everybody loves the company. Nobody wants to sell Amazon, but you want to buy 10 shares. What are you going to do? You're going to go on a corner of Young and Bloor and say, oh, please sell me some shares of Amazon? Probably not. Probably
Yeah,
not.
market maker.
Yes.
Market maker.
Yes.
Yeah.
Yes. Mr. Market Maker, he's going to sell you 10 shares of Amazon.
Yeah, and they're going to scalp you on a couple cents on the transaction, and then that's their game. They're not
You're
investing. They're
absolutely
just
right. And you know
playing
why?
math.
Okay, maybe so. Look, if you buy 10 shares of Amazon, and you should be, although it's a small lot, he will charge you some extra because it's less than 100 shares. The lot is 100 shares. You're buying only 10 shares, you will lose a little bit of money, but that's not a big deal. The big deal, you have to understand how the market maker is working. Each big investment bank, whether it's Goldman Sachs or JP Morgan or whoever they are, they have market makers. And when market maker is, let's see, if it's a big stock like Microsoft, he's allocated to trade just one stock, Microsoft. He is market maker in Microsoft and nothing else. He cannot touch any other stock. All day from morning, 9:30 until 4 o'clock, he's going to trade stock of Microsoft. Now, how is it really done? In the morning, he's given allocation, say $50 million cash and a million shares of Microsoft. Now, it depends on market conditions, on flow of bids and asks and offers to buy and sell, in other words, and so on. Microsoft will fluctuate its price like it fluctuates today. Now it's $209.64. It was already $211. It was as low as $208, whatever. How these fluctuations happen? Because of the orders coming in, orders to buy, so stock going higher in price, orders to sell goes lower in price. So what is he doing? So when people more want to buy Microsoft, so he raises the prices and he sells his inventory of Microsoft stocks. When there's orders to sell, obviously he lowers the prices and he's buying the shares which he sold earlier. But one important thing what you have to understand, at the end of the day, he has to have the same 1 million shares where he started the morning. So he started morning with 1 million shares of Microsoft in his account. He has to end the day with 1 million shares of Microsoft. Now, the $50 million cash that he had during in the morning, that will fluctuate. Depends on his skills, his luck, maybe. I don't know what else, to his techniques, whatever it might be. That will fluctuate during the day, and at the end of the day, good trader will finish with $55 million. The bad trader will finish, the market maker will finish with $45 million. But he must have the same million shares of Microsoft. Okay. So if there is a distribution of shares and he's selling his Microsoft shares and people are paying good prices or so on, but he has to be mindful that by the end of the day, he still must show 1 million shares. Where is he going to take his 1 million shares? What he's going to do? Let's see if people are buying and buying and he's selling and selling. Sure, he's selling at higher prices. Good for him. But at the end of the day, let's see, 5 minutes after 4, the boss will ask him, hey, Johnny, where's your 1 million shares? You have only 900,000. You're fired. Okay, so you don't want to have that happen to you, right? So you have to go and buy 100,000 shares of Microsoft to have 1 million, right? What's happened if Microsoft shares will go through the roof? So you have to pay more money. So you will lose money on your trading account. So you will have your 1 million shares of Microsoft, but your trading account will go down to $35 million. You lost 50 million. Johnny, you're fired, right? Okay. So you have
And
to
what's
understand.
interesting too about the market making stuff that is little known and actually quite shady that the SEC allows it to operate this way, that's relatively new, is there's what are called dark pools or dark pools of liquidity. And back in the day, it used to be that if you bought a block of stock, no matter who you were, who you bought it from, every transaction had to be at the time reported to an exchange. Like if me or you were to buy any amount of shares, that's who it goes through.
Right.
Like if, let's say you have 10 shares of Apple and you sell it and I'm the guy on the other screen that clicks buy at your price, it still is going through a stock exchange. Where with the dark pools, mostly because the SEC didn't really understand how they were being manipulated, they allowed these dark pools to basically be other exchanges, but that don't have to report their transactions in real time. They report them at end of day. So then really big people that could move a stock price with their transactions, like big hedge funds, they'll buy, or that need to buy like a block of Amazon, let's say, they'll buy their block through the market making dark pool and then know that the public doesn't find out about the prices that it was bought at until the next day. So then that can obviously help them because then people don't have the price being moved around like it would, forcing them to buy the second half of their block at a higher price rather than where it would have been without their transaction. Then on the other side, why the black pools do it is their business isn't even in betting it goes up or down. They just have these blocks basically sitting in wait for these big shops to buy. And then they know, they're like, okay, basically for the privilege of buying it in a block from me and having this ability to disguise the price, they charge them some little amount more per share that doesn't mean anything for the hedge fund, but that their whole business is just collecting pennies and spreads.
That's so
yeah,
interesting.
especially it became very fashionable with the invention of electronic exchanges. So
Yeah.
a lot of stocks are going not through the New York Stock Exchange, for example, or Nasdaq, but they're going through different electronic exchanges and they have their own reporting or so on. So, I mean, the game is obviously very complicated, okay, as we know. And as we speak, Microsoft stock is now $210 and about 18 cents or so. So as you see, it fluctuates. Probably market maker is selling a little bit more stock at higher prices.
A little.
So, well, he wants to have a nice steak dinner today, so he's working extra hard, and hopefully he'll do exactly that soon. Okay, tell me, Matthew, do you have some ideas what we discussed about calls, as covered calls and some? Do you pick up some ideas how it's being traded and how it works?
I picked up a bit. I did some further researching on it while you guys were talking, and took some notes down. I kind of gathered that it comes from the company itself, or I don't know.
Well, it's same as with stock. You don't buy options from company itself. I'm not talking about compensation options to people who work for the company or so on. I'm not talking about that. But I'm talking about the trading option which are trading on Chicago Board of Trade or some other exchanges. So really what's happening is a call is a contract
Yes.
between seller and a buyer. Now, when you are buying option call, for example, you have an option, but not obligation to do something by the time the call expires. You have no obligation whatsoever. You have only option. Let's see if you today buy option to buy Microsoft, say by third Friday of November, I think it's November 20th, you buy option to buy Microsoft at $215, and you pay some money for it, okay? So if Microsoft is $215 or lower, there is no point for you to exercise that option. I mean, your option, unfortunately, will expire worthless, and okay, so you will do something else. Bye-bye. However, if stock Microsoft is trading 215.5 or higher, then you, of course, will exercise your option. So now you have a right, not obligation, but a right to acquire. Say if you have one call, you will acquire 100 shares. One call is equal to 100 shares. So you will acquire 100 shares of Microsoft at $215, while stock maybe is trading at 220 or 250 a share. Who knows what Microsoft will be trading by third Friday of November. And you have option to acquire at 215. Zach, would you like to add something to this concept?
Yeah, with options, what's great about them, but also can be bad if people are using them inappropriately, is that they are a great way to add leverage and exposure to your position. But another thing that they provide is if you want to protect a position that is in the underlying stock, you can use options betting the other way against it during really volatile times in the markets. Like as an example, let's say you own Amazon as a long-term position and you like the company overall, but you're not a trader that bought it 3 days before earnings and held it through because you think this earnings report is going to be a blowout. Then what you can do is you can actually, to a proper position size, you can calculate it, and you can buy puts basically betting against your current position. And the options would just carry you through the period of earnings where it'll be super volatile. So then if something ridiculous happens and the stock tanks, then you make it and so much on your options that it's not a big deal that your long-term position went down like that for this weird short-term event.
Okay, so in this case, you would use option both as protection and also as a cash generator, because obviously, if you will sell volatility, you will be paid much juicier premium for that, and you will collect more money. That's just as simple as that. And then volatility will go down after earnings reports, for example, or market conditions or so on. So you can always make some nice profit of it. Jim, would you agree with that?
You lost me at the how do you make money? You're saying there's income provided by buying the options, and that's where I lost you.
No, not by buying the options, by selling the options. You don't get income by buying option. By
No.
buying option, you actually create a leverage that, okay, to buy 100 shares of Microsoft will cost you, say, without margin,
That part I got.
21,000. Now with the buying option, it will cost you a few $100s. So
Yeah.
obviously that, and you're participating in the upside, if there will be upside, as you predict. The only thing is that what I was discussing with Shaquille, that from 1973, when the options started to trade on Chicago Board of Trade, until today, 2020, there was only 1 year when buyers of options beat sellers. It was 1987, the year when stock market crashed
Black money.
22% in 1 day, right? So that was 1 year. So we are talking about a situation where in 47 years, 46 years, the sellers beat buyers, and only 1 year when the buyers beat sellers. Okay, you have to be mindful. It doesn't mean that any particular position you as a seller will win against the buyer. It doesn't mean that. It's just the statistics. It's well-known statistics.
I
And
understand.
sometimes when you want to bet against statistics, and as even Shaquille recognized that
I
80% of options are expiring forceless. However, again, if it's a part of your investment strategy and hedging strategy or whatever, okay, you probably will accept it.
But Sasha, where I'm losing you, because I understand the puts and the calls and how it can protect your investment or increase your leverage. But you mentioned the word income, and that's where I lost you. I don't know where the income is coming in.
Okay. I own 700 shares of Altria. Forget about dividends. I own just stock. Now, if I sell, if stock is not really moving, it doesn't have a high beta, it doesn't move much higher or much lower at any given time. Okay, you can go higher maybe in next 3 months, probably to $43, and it could go lower to $38 perhaps, not lower than that. Okay, providing there will be no market crash or anything. That's about trading range.
Okay.
So if I'm selling, let's see, November 20th calls, I will be paid for, I will sell 7 calls. Each call will cost, say, probably $2.50, right? So how much money I will collect on 7 calls? I would collect $1,200 and say $1,300, right? Does it make sense?
I'm not quite understanding. I'm sorry, I'm being dense, but
Okay, well,
I
listen,
understand how
relax.
you can make
Jim,
money, but I
relax.
don't understand how it's
No, Jim, just relax. Altria is trading. Okay, let me see what is it doing today. I haven't even looked at it. It's boring stock. It's not really doing much. Okay, it's now $41.18. Okay, $41.18. Now, if okay, let's imagine that I will sell $42 calls for November, and buyer of these calls will pay me, say, $2 a call. Seven calls will generate $1,400.
now
Commissions are very low. I'm trading, my commissions are $4.95. So it's negligible. I don't even count them at all.
I understand.
Okay. So $1,400, isn't it an income, or how would you like to qualify it then?
I get it. I get what you're saying now.
Okay, so it is an income, or at the same time it is also a protection, because I paid $2. So now I don't care that the stock will go down to $39. I'm still in the money. I'm not losing anything because somebody paid me. I told him, thank you very much. You're a very nice man that you paid me this money. Would you like to buy more calls? Or always be glad to sell you something. So please give me a call. Don't leave home without it, and just come back to see me.
Yeah.
Okay. Because essentially, what really he's buying time.
I understand.
Buying nothing but time. I sold him some time. He paid me the money. So I will go to a nice restaurant and we'll have cigar and nice bottle of wine. And we'll tell him thank you, thank you, thank you. Right? Okay, Jim. So that would answer your
Yes.
question?
Yes.
Okay.
The one thing that I would personally do just for my own like well-being, if I ever sell premium, or which is just a term for selling options and getting the premium payment, is if you're selling, obviously, let's say you're selling a put, then the most you can lose is 100% for if the like of the underlying moving 100% from whatever price to zero. But on the other way, if you're selling a call, even though there's some hypothetical limit to what any company could trade at, if you're just talking the mathematical rules, it's infinity that it could trade to, right, on the upside.
Well, let's
But
be
just,
reasonable. Yeah.
yeah, just for my own sanity, if I ever, which I rarely would, but if I ever was in a situation where I would sell a call, then what I would do just to give myself additional protection is I'd basically look at puts that are like way out of the money, and I'd find some level there that I'm comfortable with creating as my maximum possible loss. And then I'd buy some really cheap puts out there that would, I calculate, so if the
You're
world
talking about spreads. You're talking about spreads. Yeah. Spreads next week. How about that?
Okay. But
Yeah.
Sasha, I was lost on the word income, and if Zach used the word premium, and that made
there you go, yeah.
sense to me. Yeah.
Oh, okay. So you're uncomfortable with income, but you're okay with premium, right?
Yes, but it was just for my own mind.
I have that a lot with things where just one term is what you're used to.
Yeah,
So then,
it was just the terminology, because income means dividends to me, and that's not.
Or like, if I called some chess piece something different that you didn't know that term, then you'd be lost at sea talking about chess, even though you know more about chess than I do.
Zach, do you play chess?
I don't, but I want to get into it.
Yeah, you see, Jim wrote the book Chess for Dummies.
That's cool.
Yeah, it's been translated in 198 languages around the world. And
He only
it's
exaggerates
really good.
slightly.
Yeah.
It's been translated into many languages, including Russian.
Oh, you know how many old languages around the world there exist? 5,776 languages.
Wow.
So there are a lot of languages that it hasn't been translated yet. You have to start work on it. Are you doing translations yourself, or you have some translators?
I don't do any translations. No, they're all, and whenever it's translated into another language, which I could pick this one up, they usually list who the translator is.
So, it's a German, right?
Yes.
Deutsche Deutschland über alles.
Yes, and I have Hydrus as well, Spanish, French.
Has it been translated to Urdu?
No.
How come?
No. So my Pakistani friends are out of luck.
Oh.
Okay, Jim. Once next week we are going to discuss, if you don't mind, the spreads. Okay.
Yes, I would love that.
Matthew, read a little bit more about calls and puts, because you have to really understand that well before we will start going into spreads. And then in 2 weeks' time, Jim, you're going to write a book, Spreads for Dummies, right?
Yeah.
How about that?
I'll co-author that.
Well, I'll get Zach to write it, and I'll take credit for it.
Yeah.
Okay. That's our project. Spreads for Dummies. Well done. Okay, guys.
I'd like the Oracle of Ontario to write it. I'll get them connected.
Perfect.
Thank you so much for today's program. I hope next time we will be all on time, 5 to 1 on Wednesday. Okay. I will send you a link, and we're going right into spreads. So please get ready. Is that okay with everybody?
Yeah.
That's good for me.
I'll save it for the spreads episode. But there's a good story, not from me personally, but someone I know, talking about how you really need to know every part of a spread, because if you miss even one detail, then it could be drastically different than what you thought the parameters were.
Okay, I'll be listening with both ears.
Perfect.
Yes. Okay. Thank you so much for participating in today's program. See you all next Wednesday at 5 to 1.
Perfect.
Thank you very much.
Matthew, I'm taking notes too. You're not the only one.
Please do. Everybody.
Now I need
Yeah.
to go and get a copy of Chess for Dummies.
There you go. What a great show you had, Sasha.
Not a castle. It's a rook.
Yeah.
It's not a
Okay,
cat.
Jim, you have any books to sell us in bulk? Like 500 copies?
I do not. No. That was I wrote it in it was published in 1996. So all that was given to me has been given away.
So I'm pretty sure all dummies already bought your book, so we have to now start.
It's a renewable resource, Sasha.
There's always more dummies.
Yeah, we need more dummies, please.
There's one born every minute.
You should come out with cigar smoking for dummies.
There you go.
Oh, yeah.
You're into.
Cigars for dummies. Cigar aficionado.
Cigars from dummies, yeah. That's a good one, yes.
Yeah.
Okay, guys, thank you very much
Sasha, I
again.
learned so much today.
Looking forward to see you
Thank you,
all
Zach.
next Wednesday.
It was great to be on here. Yeah.
And also we have, Jim has on Tuesday's chess show, and I have one on Saturday at 3 o'clock. Okay?
Who usually wins in chess, just so that I can know where to bet on?
Well, no, whenever I play Sasha, I have to use one of these lidocaine patches because my head starts hurting.
Well, I'm trying to. I have to.
Well, if you were betting on us, you would bet. You would make or lose money either way because we'd beat you about 50-50.
have to use
50-50?
some special dress for playing chess.
There you go. I'm already intimidated, Sasha.
Yeah, because you have a hat and I don't. It's a fair advantage.
But this is a hooligan hat. It's not a yacht hat.
That was for all our female viewers right there.
That's good. Yeah. I'll have to get flasher short because
Gosh.
Jim, you are
I'm
outdressing me every time, so it's not fair. Okay, guys, thank you so much again, and see you next Wednesday. Bye, everybody.
Bye.
Bye.
Oops. I'm gonna